There we go. We are live for let's call it part two, shall we, Alan? Of
Yeah, exactly.
discussing these 95%. Yeah,
Yeah.
we wanted to continue it, didn't we? Because I think we left it open ended to see what was going to happen with these 95% loan to values, and I think it's always good to have a conversation, estate agent and mortgage broker kind of working hand in hand to try and help everyone out there get an insight into what we're seeing, because I guess we're seeing it firsthand, and a lot of people in the press then see the statistics from 3 months down the line, but we see it firsthand, don't we? So it's good to share. It's good to share. But how are you doing anyway?
Yeah, we're extremely busy at the moment. It's really, really good times. It's the lenders are slowly getting back up to speed on their processing. And that's brought in, because they can now cope with the volume of business, that has brought in a lot of quite a few rate reductions, especially over the last month. In the last week alone, we've had NatWest, Santander and Halifax all reduce rates by up to 0.31%. So, it's a buyer's market, as they say, whether you're buying a house or whether you're buying a mortgage for remortgage. It's positive, very positive.
That's some serious players in the mortgage game with some serious reductions. And I remember some conversations I was having with the other avocado partners on a live much like this, and we were talking about, are we entering a market boom? Because it felt like we were moving into it with banks dropping interest rates significantly, with potentially a shortage of properties post stamp duty holiday, and clearly an increase in demand. But I would imagine you're seeing a lot more potential applicants, potential buyers looking, or a consistent theme for the last 6 months, because life's different, isn't it, at the moment?
Absolutely. We've been consistently busy all year, especially we were busy, and then all of a sudden the stamp duty holiday came in, which gave it another kickstart. But first-time buyers are certainly out there. The only problem we got with first-time buyers is affordability. But you get some youngsters on some good wages these days. It's very good. But for lenders at 95% will only give you 4.49 times your income or joint income, which means if they want to buy a house 300,000 with a 5% deposit, they've got to have an income or a sole income or a joint income of about 65,000.
Which
so that's a stretch.
It is out there though, isn't it? I think we were talking off camera about how fortunate we are to work in the home counties area, Berkshire, Surrey, North Hampshire, and the salaries are out there. And the amount of tenants I actually register that are actively looking for rental properties with that level of income is staggering, looking at 2-bed flats and things like that to rent that have that income. So if they can just save that 5%, or even better, get that 10%, then people are out there to do it. And I guess that's why we're so busy at the moment, really, is
absolutely. At the on the flats, the leasehold properties, the lenders are still sticking at 10% at the moment, 10% deposit. The 5% are no new builds, but obviously for first-time buyers, the Help to Buy is still available there. But they're really, it will take time. It only takes one to come into the market. 2 weeks ago, we only had 2 or 3 people out there at 95%. Well, most of the high street lenders, what I would call high street lenders, the only one that hasn't joined the party so far is Nationwide, but they won't be far behind. They'll dip their toe in the water very shortly, I would imagine.
Yeah. Andy's jumped on here. We sort of covered that there, which is why I threw the chat in there, because lenders have now brought in new homes and flats on the 95% schemes. But you're saying no, not at this point.
Not at the moment, no.
Not at the moment.
Which is a shame, but at least there's something out there. That's the good thing. The Help to Buy is still available on those, but it's just a matter of waiting. If you think about it, when last time we spoke, I think the time before that, 90% rates were almost 4%. Yep. Well, they're down to 3.19. That's come down in 4 or 5 months. So with 95s coming in at 4%, how long is it going to be before they come down? Because the lenders have all got shelf fulls of money. They're only making money if it's lent. So the only way they can compete is on interest rate, which is a fantastic thing for buyers.
And I guess that answers Sanjay's question there, which is, last time we were talking about the market being so busy. We're equally talking about the busyness of the market. And Sanjay asked the question, why do the banks keep dropping these interest rates? And I guess, well, I'll let you answer it. I've got my view, which they did sort of when the 90% loans values came in, they started them high and they've sort of incrementally dropped them. The 95s potentially the same and incrementally dropped them. But when it's competitive, the way
absolutely, I think it is a competition, and I think maybe the banks, people don't understand. Although the Bank of England base rate is 0.1%, that is not where the lenders borrow their money from. They get their money commercially, so they've got to turn a profit on it. They're not making 4% profit because Bank of England base rate is 1.1%. But I think it's the lenders, they're out there to make a profit. And I just think the first ones to put their toe in the water, they're coming in at 4%. And they obviously, what they want to do, the first ones in, they want to manage their processing times. They don't want to be the only ones out there. They don't want to be inundated with business at 95%, and that kill off their mainstream 75% sub business. So it's a good thing in a way, but most lenders are out there now at 90%, and those rates have come down from 4% to 3.1.
It's big changes. It looks positive, doesn't it? Even with stamp duty now being almost a non-entity for people that are coming to the market and buyers that are now deciding, right, we are ready, we've saved enough deposit, we've got our application in principle. Really, they're not going to benefit from the stamp duty unless it's under the 250 bracket, but the 500k one. But it does seem like people are almost ignoring that. And I don't know what you're finding, Alan, but I'm finding a lot of people are based around trends. People are fed up of working with laptop on their sofas, and they're fed up with working from their dining tables. And they're saying to us, look, we're going to be indefinitely working from home now, so we need an extra bedroom, or we need an extra reception room. And I think that's going to carry on for the rest of the year, I would imagine. So if the rates stay cheap and the demand is there and there's less properties on, inevitably we're going to see prices continue to climb, I would imagine, if that happens. Is that kind of your view across the rest of the year?
I think so. I mean, there's a lot of homeworking going on now. You look on social media, likes of Facebook, and everyone's asking for, do you know anyone who can convert my garage into an office? Do you know anyone who can give me a garden office, etc., etc.? And there's loads of them. Facebook is inundated with it. So I think even the smaller builders and the DIY people, they're having trouble keeping up with demand there, which is good. But of course, not everyone's got a garage. Not everyone's got, and it's not big enough because the garage is already full up with stuff when they first moved in. They haven't put it away yet. So I think it's great, but I'm just not sure whether the demand is going to whether the supply is going to be able to keep up with the demand, especially in the areas we're working in.
Well, it's interesting because Zoopla reported a few weeks ago, actually, they showed statistics that basically said if it carries on at this rate, and I think they had 14% up on demand, 12% down on supply. If it carries on at that rate, then we are heading towards basically no properties available for people to buy. It's that kind of barrier that we were heading towards effectively. And I talked to a lot of estate agents, and a lot of people are saying it's the lowest amount of stock that they've had for a good 15-20 years, which is interesting because I think what the stamp duty holiday has done is it's brought this massive influx of people looking to move. And I guess the only real question mark for buyers out there at the moment is how much is going to be on the market over the rest of this year. And really, I guess one of the key factors, we're going back on those leaseholds, is if a lender comes in and says, here's a great rate with a high loan to value percentage, and it's available for leaseholds, that's probably that next catapult to see the flats start moving and people start buying there, and maybe tenants that are in rented that can't afford 300 but could afford a one bed at 210 or a two bed at 250. That gets that end of the market kicking off as well, which would be quite interesting. Is there any signs of that with leasehold sort of better mortgages coming into play, do you think?
I hope it's going to come along. The government guarantee scheme should be able to cover it. It's always a fickle thing, because the problem we have is lenders majority of lenders, the high street lenders, don't lend regionally. They lend nationally. So what they're concerned about is London property prices, flats prices, even where we are, home counties, is they're so expensive anyway, and a small fluctuation is they could go into negative equity, and that's their worry. But the guarantee scheme is guaranteeing it at 20%. So I don't know. Does the government want to put it on? I think a lot of the stock as well, where the 2-bed flats would have been first-time buyer fodder, is a lot of those are snapped up by the buy-to-let people. So unless they get out, so it's a chicken and egg situation, really, isn't it? As long as people are buying them to rent them out, they're not available to buy, so you've got to rent.
Yeah. We've seen a huge increase in investors. It moves on nicely to my next point, really, about buy-to-let mortgages. Seen a huge increase in people looking to do buy-to-lets. In fact, last week alone, just myself and Mike, we let 6 properties to people that had effectively purchased those properties through us recently. And it's a lot of people out there now that are deciding it is a solid place to put their money, and maybe they've never been a landlord before. It's the first time that they've been a landlord, but they're fed up of leaving savings in the account without it really doing anything, and they're thinking this is a good place to put it. So, are there good buy-to-let options out there for people at the moment?
There are, whereas it always used to be, as long as you've got 25% deposit, then you're fine. But where we find, especially around our area, is you look at a £300,000 apartment, it's going to get £1,000. Well, you're not going to get 75% borrowing on that. You're going to need to probably put in 35% as a deposit. But yeah, still there, and still a very, very good return on investment.
Yeah, I think I think people have to be sensible with their purchase, but there's properties out there, even in this area, as good as sort of 5.5–6% yield. But I guess the lenders, what they're looking at is, does it stack up on, the value of the cost of the mortgage monthly versus the rent, and they have their ratios on the stress test to work towards.
Absolutely, yeah.
Have they eased at all, the stress testing, or is it still as high as it was 18 months ago?
Still quite as high. I mean, what a lot of lenders are saying, we'll tie in for 5 years or 10 years, and we'll give you a bit more money. But of course, it's they haven't really the 2-year money, where people, because you look at the people who want to dip the toe in for the first time, is do they want to be tied in for 5 years if it doesn't actually work with them? If they're not going to put a letting agent there to run it for them, there's all that fraughtness of getting the phone call when you're on a family barbecue on a Sunday afternoon, if someone's got a leak, boilers packed up, etc., etc. So it's not everyone is going to go into it long term, but they want to chance it, as you say, because they want to get their money in something that's going to give them more than 1% per annum, like the bank's savings.
Yeah. I think that's the key thing, isn't it? Is it a better pension option for me if I can make the money work on it? What about remortgages? I saw a low loan to value. I think it was 60% loan to value, something like that. Deal being touted around. I think it might have even started today, but it was around 1% interest rate.
Yeah, they're out there.
That's amazing.
Yeah. It's, I
and
think
would you be advising?
I haven't found the one. Someone said on the news that it's 0.99, but there's certainly deals out there at 1.06, which absolutely crazy money.
Unbelievable, really. Would you be telling these people to kind of fix in? Would you be telling these people to kind of go for a 5-year fixed, 10-year fixed at the moment?
Well, the problem you have is you haven't, but they're not offering that at that loan to value. At that rate for a long term. Those are sort of 2-year deals.
Okay. And what's the strangest request you've had so far this year? What's the oddest buyer request you've had so far this year?
Oh Goodness gracious, you put me on the spot there.
Put you on the spot
I've had
there.
a guy who wants to remortgage a Cornish prefab in Devon, which is basically, if you've ever seen a concrete garage, it's that with plasterboard on the inside, and unfortunately they are unmortgageable, that particular type. But he's still convinced. He still rings me every other week and saying, I really need to pull some money out of here. It's just people don't give up. I've had a lot of people that they find things, and one of our biggest bugbears is you get dad or you get your mate down the pub who says, oh no, you can get more than that, and there's a better rate than that. And you get people ring out, and Scottish Building Society. Well, that's very good. Yes, they have got a nice cheap rate, the Scottish Building Society, but you're not buying a property in Scotland.
No.
Oh, okay. So in some ways, the internet is very, very, very dangerous. We also get people that most mortgages are portable. And I've had one client where they want to move, and because they've already got a mortgage, they think the lender will automatically just move it for them. The only reason it's portable is so that you don't pay the early redemption charge. So, we've had people that have offered and had their offer accepted, instructed solicitors at 400,000. They're already borrowing 200,000, but the reason for the move is they're splitting up from their partner. So their salary won't even borrow what they need. So their salary only dictates they can borrow 120, but in their mind is they've got a mortgage and it's portable. It's very, very dangerous trying to do it DIY, when all you've got to do is, give us a call and we'll talk you through it. There are different ways. One particular person, we brought her father onto the mortgage with her. So
there's options.
Absolutely. There's lots of ways of looking at it. All I'd say is trying to do the DIY of it, trying to work. The internet is a minefield.
I say to so many buyers when they register, what have you done so far on your mortgage? Oh, we've looked into it and we're okay. Well, what do you mean by that? And often it's a bit of Google searching. These videos are not here as a plug for my services or yours, but at the same time, the difference with talking to someone like Alan, if you are looking to purchase, remortgage, is you've got seasoned experience and someone that can give you advice. And that's the difference between going to your bank, where you can sit there and have a conversation these days rather than going into the high street, but they're telling you which products are available rather than giving you advice on what's best to you. So, if there are people watching, ask us a question. If you've got a question, fire it in. I know Andy's got one here, but just from my perspective, talk to Alan, talk to his business partner, Dave, and these guys will be able to help you with advice rather than just information. Andy Mead has asked, he's been offered 1.35 on a 5-year fixed remortgage. Is that good? I guess you need to know the loan to value on it to answer that question, do you?
Well, just looking at the rate for 5 years, I'd snatch the hand off Andy. It's a fantastic deal.
So yes, whatever the loan to value is, go for it, basically.
Absolutely. Absolutely.
We are lucky at the moment, aren't we? Because when it comes down to affordability, we're in a position at the moment where it's the cheapest thing to do at the moment is to get a mortgage. And there's a lot of people out there at the moment that I think underestimate the value of having that mortgage at the moment. And if you've got, this is slightly different off tangent, but if you've got car finance or you've got a credit card and you're overpaying that 10% on your mortgage, just think about the interest rates different and get your credit card cleared before and get your car finance paid off before, because your mortgage is the cheapest money that you're borrowing at the moment. And then when you do come to look to move and you talk to Alan, when you've got those debts paid off and you've just got your mortgage, which is the cheapest interest rate, you're going to be in a position, I would imagine, Alan, where you can hopefully lend a little bit more and borrow a little bit more by just having the mortgage that you're transferring.
Absolutely. Yeah, it's very important, because what you got to think about there is all of these different criteria. It's dangerous looking at it yourself, because you've got the likes of Santander. They're doing the 95% scheme now, but they won't do it for self-employed. They'll only go up to 75% loan to value on self-employed people. you've got some people, they won't even look at people who are furloughed. Barclays will accept furlough pay. So it's, you go on these search calculators and the internet and you think, oh, that's it, I've got it. Yeah, great. But, even some lenders still class you as a first-time buyer if one of you is a first-time buyer. Others, if one of you has owned before, it wipes you out of the first-time buyer deal. So all of these things is, you're not going to pick this up. You could waste hours on the internet thinking you've done the best deal and that's the rate you're going to get your deal for, just to be upset.
It is a time sapper that people could save so much time by not getting caught on what I call the hook deals, because the lenders put them on Google to hook you in. They're hooking your data in, aren't they, effectively? And
absolutely,
going straight to someone like Alan, having a chat with us, and we can put you in contact. It's going to help you massively save some time, but also get the right advice. It's interesting what you say about major lenders, some looking at furlough, some not, some interested in self-employed, some not. Going back on 95s, Alan, because obviously we spoke about it before, and I think we both felt uncomfortable about advising them as the right thing to do at the moment. We both didn't feel at 4.09, 5-year fixed, a 95% loan to value was probably the right advice to give a first time buyer. There's deals now that you would feel a bit more comfortable saying to someone.
Now lenders have come out with the 2 years. I'm much more comfortable in that, because realistically, if you take a 30-year term mortgage, if you start on you buy a house at 300,000, put a 15,000 deposit into 5%, that's going to cost you 1,360 a month on mortgage payments. But that means over 2 years, just by paying that 1,360, that would have paid off an additional 10,200 off the capital. So I don't know, look at it conservatively. You can't guarantee the properties are going to go up, but where we are for the last 10, 15 years, they always have. If they went up by 2% a year, that same house would be worth 312. So if you then look at the 274,800, which is left on the mortgage after 2 years, and then push that into the 312 new val, you're all of a sudden at 88%. So you've already paid it for 2 years. So reduce the term for 28 years, that 1,360 goes down to 1,248, because you're going down from a rate of 4% down to 3.2.
It's powerful stuff, isn't it?
Oh, absolutely.
We're in a bit of a privileged industry, or industries, to work in at the moment, bearing in mind the climate and what everyone's going through. And it's nice to know that things are back opening now fully, and the economy hopefully booms from that as well, in the same way the property market has and the mortgage rates have, and hopefully everyone's in a pub garden at the moment, aren't they? You can't get a booking anywhere, so hopefully that gets those industries back up and rocking and rolling, which would be great for the whole economy. But I guess the question that I've got here is inflation. And I know it's not our bag to talk about, and we're not experts, it's just our opinion. But do you think that, in the next sort of 2 or 3 years, we're going to see higher inflation, and therefore the Bank of England base rate is going to creep back up? Do you think that's no time soon? I'm not expecting anything in the next 18 months.
Well, we all get trade magazines.
Do you sort of say again?
Sorry, we all get trade magazines and look at these different forums, etc. And you get economists making things in it. Most of the economists are saying no change for 3 years. There's an awful lot of money out in the country, and no one can go out and spend it. They're starting to now. But I really don't see, my personal opinion is, I don't see that the country is not going to run away. The economy is not going to run away. And the only time they would put the interest rate up is if they want people to stop spending. At the moment, I think they want to get so much money back into the economy, they want everyone to spend. So I really don't see in the next 2 or 3 years rates increasing.
Yeah, I'm of the same view. And then I think we'll see where we are in 2 or 3 years' time. Maybe things will change. But at the moment, get that money that people haven't been able to spend back into the UK economy, and get people back employed. The younger group of people that maybe have struggled with furlough and redundancies and things like that, get those people back employed. I mean, rental is unbelievable at the moment. You know, I can't stress enough how many tenants are out there actively looking for properties to rent. So there's people that want to move in the tenant market, and that's at all shapes and sizes. You know, we're letting properties at £3,000 a month down to kind of £850 a month, and having equal amounts of strong tenants. If anything, more tenant demand on the higher value properties at the moment. And I guess there are people out there that are being quite shrewd and thinking, well, I might do a let to buy at the moment and things like that. Are you seeing many people look at that as an option at the moment, where they're renting theirs out to purchase?
Yeah, we've got quite a few people doing that, to be honest. It is, and this is where they are looking at it for pension. You know, they've got the additional money. Sometimes they've only got a very small mortgage, or they can top up and get additional funds out of that by putting it on a buy-to-let. A lot of people getting into it, and obviously it's happened a lot this year. But you know, it's additional stamp duty.
Yeah.
So you've seriously got to look at it, especially because, you know, normally the house they're moving on to is the expensive one. So, and they're going to be paying the additional stamp duty on the bigger property, not on the one they're moving out of. So, but yeah, a lot of people doing it.
I guess people will look at the numbers and they'll see, I think you said 7% plus the last 12 months. It depends what platform you look at for house price increase, but whether you're looking at the Halifax house price index or the Nationwide or Rightmove, whatever. But then nearly all of them are sitting around 7 and 7.5% increase year on year. So I guess even if we look at the stamp duty additional 3% spend on the price, if in 12 months' time you've gained 7% equity, then
absolutely, it's paid for. It's a no-brainer.
Yeah, it's a no-brainer. And I guess a lot of people, what I'm finding at the moment is, you obviously see the let to buys, but I see the reason for the let to buy, and quite often it's, I'm going to let my property around here and I'm relocating to the New Forest or the coast or the Cotswolds or wherever it may be, you know, countryside of Wales, and often buy a property that's a little bit cheaper in a much nicer area. And then I guess whether they to and fro back from the other one to the other, they've got two properties that are gaining value and they've got a different way of life, I guess, is what people are looking for, is a different lifestyle, as we're in such a different climate now. So you're feeling positive overall then, Alan, about the market? You feel good for the rest?
Absolutely, yeah. It's booming, absolutely booming. I mean, going on from what you were just saying there, we've had a couple that they've now had it confirmed that both of their jobs will be permanently from home. So they're now not going to live near a station. They're not going to live within 40 minutes of London. And they're going out to the Oxfordshire countryside, and they can get a place twice the size of where they have been living for the same money.
Interesting.
So, you know, I think the COVID lockdown and everyone working from home and showing that Zoom does work and you don't actually need to be in the office is a real boom.
Yeah. I wouldn't imagine you've probably had much of this action yet, but Hong Kong is becoming quite a topical point in the property market at the moment, because we're seeing a lot of Hong Kong nationals, or kind of British passport Hong Kong nationals, relocating over to the UK at the moment in volume, with a visa change that happened over there. They're looking to rent properties for 12 months up front cash. They're looking to buy properties cash, and they're looking to get jobs after they've found accommodation. You'll obviously see the impact of those significantly in 12 to 2 years' time as they become employed. That's an interesting part of the market, because it's forecast that maybe up to 300,000 Hong Kong nationals could relocate over to UK on these 5-year visas. Are you seeing any of those jumping straight into mortgages yet, or is that not?
I can't say as I have, no, but I think on the flip side of that, there's an awful lot of other nationalities that are exiting.
Okay. Any trends there that you're seeing over this year, or everyone?
It's a bit of a mixture, really. It's, you know, lenders are looking at their EU rules and who can, who can't, you know, what settlement status have you got now, etc., etc. And a lot of people are going, okay, we've had 2 or 3 years here. Let's go back to the home country.
I've got Luke actually that's just tagged in. He said, seen lots of Hong Kong nationals buying commercial property cash, as well as lots of their money coming into the market. So it's definitely something we're seeing. It's a trend to look out for, and I would imagine the mortgages will flow from those cash purchases maybe in 2 years' time. But it's quite interesting to see a read on that. I'd probably say for us at the moment, from a tenant perspective, maybe 1 in 10 will be from Hong Kong, and from a buyer perspective, maybe 1 in 20, which is quite significant when you think about it.
Huge numbers.
Yeah, especially when they're cash purchase or cash up front. Alan, I've taken half an hour of your time, and as always, I massively appreciate your wisdom and your advice. The original avocado Alan. Anything that you would like to finish on, or any extra bits of wisdom that you want to pass? I know we've covered a lot there.
I just think that rather than getting yourself frustrated, rather than going to sit down with your own bank for 2 hours to then get a no or a maybe, just pick up the phone, give us a call. It's free advice. We'll point you in the right direction, and we'll be totally honest with you. We won't lead you astray or string you along.
And I massively vouch for that. I've worked in the industry for the best part of 20 years, and Alan and the guys at AFP Wokenham, they're phenomenal when it comes to handling first-time buyers, buy-to-lets, people self-employed, people looking at remortgages, all different types of people. Everyone I've ever passed as a referral over to these guys has always come back and said thank you to me. And I stress so much to people, don't waste your time on Google, pick up the phone. Alan can see what's going on in the whole of market, whether we can offer whole of market, he can see what's going on in the whole of market, and he can give you the right advice in terms of what you should be going for, rather than just saying these are the options which you'll get directly from the bank. So pick up the phone, give him a call. I'll put in the comments after the video, obviously the link through to Alan's website and contact details. If you're watching this not live, chuck in questions in the comments. We will check in with those, over the next 24 hours and the rest of the week, and we will answer those comments. So don't worry if you're watching this and it's not live, still comment below, and we'll love to answer those. Alan, I will let you get to it. It's Monday. I'm sure you're a busy man, and thank you so much for your time. And
my pleasure as always.
Hopefully we'll do part 3 at some point in May.
Yeah.
See you soon.
See you later.